Good morning, everyone. How are you all? Have you revised the concepts, whatever we have done till today? Good morning, good morning, good morning, everyone. So I can see we have Nisha, Sahil, Stephen, Sumit, Niranjan. Good morning, everyone, once again. Okay, so let's just quickly recap with what we have done till now briefly, and then let's take the discussion forward with the subsequent concepts and the questions. So first we have started with the inflation adjusted NPV, where we had a very simple fundamental where we said that nominal cash flow should be discounted at nominal rate and real cash flow should be discounted at real rate, right? Then we have obviously observed that real rate of return is going to be a lesser number than the nominal rate of return, right? Then we also saw the relation between the real rate, inflation, and the nominal rate. After that, we have done quite a few questions where we have actually computed that the tax savings on the depreciation is essentially not impacted by the inflation, and that has to be separately treated. Okay. Then we started with the risk adjustment by calculating the expected value, standard deviation, variance, and the coefficient of variation. And we obviously concluded that as the standard deviation or the coefficient of variation is higher, we observe that the particular project is having a greater amount of risk. Post that, we have also went ahead with the next technique called as the scenario analysis, right? Or sorry, sensitivity analysis. So before that sensitivity analysis, we have also taken into account the risk-adjusted rate of return and the certainty equivalent portion also. The risk-adjusted rate of return is basically the risk-free rate plus the risk premium that we add, and that risk premium actually depends on the risk of the project. And then we have also seen something called a certainty equivalent, where instead of calculating the risk-adjusted discount rate, what we do is we compute the the certain portion of the cash flow, and that certain portion of cash flow is discounted using the risk-free rate of return. Okay, and then we went ahead with the next aspect, which was sensitivity analysis. So in this sensitivity analysis, we tried to change each of the variables by an adverse percentage, and we were looking at the impact of that change on the NPV. Impact of that change on the NPV, so that and we were looking for which of those factors are actually having greater degree of sensitivity, right? So the factor which is having, or the variable which is having a greater degree of sensitivity is supposed to be kept in control, or there should be greater control based on that factor, because any change in that factor is going to lead to higher change in the NPV. Okay. Now it's time for us to take up the next concept, which is about the sensitivity, and actually not the sensitivity, scenario analysis. Okay. So scenario analysis. Just give me a moment, guys. Yeah. Scenario analysis. So when we were doing sensitivity analysis, we were essentially changing one of the variables. Like in the previous question, we were changing the selling price per unit. We were changing the variable cost per unit. We were changing the fixed cost per unit by an adverse percentage. And we were looking for impact of that adverse change on the NPV. So we were doing it one by one, right? We were doing it simply one by one. Each of the factors were analyzed. But in realistic scenario, in real life scenario, what we can say is there may be multiple impact of multiple factors, right? There may be impact of multiple factors in one go, right? So you may have that variable cost is changing and also sales is changing and maybe fixed cost is also changing. So we essentially try to look at different scenarios with multiple changes. And then we want to look at the final impact on the NPV of the project, right? So we are analyzing the project NPV by taking into account the multiple scenarios possible in future, right? And that will actually give us a value, or that actually give us a range of values of NPV, in which it can be around, right? So we may have a very worst situation, we may have a very best situation, and we may have a mediocre situation, or even we may have more than three situations also. And it will be helping us to understand where are we really ranging from, right? What is the worst NPV possible? What is the best NPV possible, right? So that is what we are looking at scenario analysis. To understand this scenario analysis better, let's look at this question number 9, guys. Question number 9, to get a better understanding of what is a scenario analysis. Okay, XYZ Limited is considering a project A with initial outlay of 14 lakh. So initial investment is 14 lakh. And the possible 3 cash inflow attached with the project are as follows. So in year 1, we may observe that we get a cash flow of 450 or 550 or 650. If it's worst situation, we may get a cash flow of just 450. If it's a most likely situation, we may get a cash flow of 550. And if it's a case where everything turns out to be in our favor and we are in the best possible situation, then what we can say is we can be expecting a 650 cash flow. Okay, so in year 1, you can expect these 3 set of cash flows. It will be either of them. You're not sure about whether it will be 450, whether it will be 550, or whether it will be 650, right? So that surety is something that we still don't have. Same goes with even year 2. Even in year 2, we find that it is 400 or 450 or 500. In year 3 also, if it's the worst situation, then we may face 700. If it's most likely, we may get a cash inflow of 800. And if it's the best case, we may get a cash inflow of 900. So we are looking at 3 different scenarios, right? So assuming the cost of capital is 9%, we have to compute the NPV in each scenario. If XYZ Limited is certain about the most likely result in the first 2 years. So the question says that if we are expecting the most likely numbers in the first 2 years and the third cash flow is uncertain, then what will be the NPV expecting that the worst situation turns out to be true in the third year? Okay, so let's compute the NPV based on the expectation. To determine, we have to compute the NPV in each of these scenarios. So if worst case turns out to be true, what is going to be the NPV? If it's most likely case throughout the life of the project, then what's likely to be the NPV? And if everything turns out to be good and everything is good and everything is going to be the best one, then what's going to be the NPV? Okay, so let's go ahead with calculation of NPV under different situation. Sorry, yes. Calculation of NPV under different scenarios. Okay. So let me write down the year and the present value factor, which is going to be a common thing for everyone, right? So year, present value factor at 9%. And then we are going to look at scenarios. First, we look at the worst case. In the worst case, we look at what are the cash flows and the PV. Okay. Then we extend it to other way around. So this is like the next is the most likely case. And similarly, we are going to have it for best case. Okay. Now, so in this table, we'll be calculating the NPV under each of the possible scenarios, which is the worst, most likely, and the best case. Okay, so cash flows, we are going to take it in thousands, okay? To make the things clearer, let's just take it in thousands. In fact, all the PVs and all everything is going to be in thousands. So years we are going to have 0, 1, 2, 3. 3 years in total. We'll write down the present value factors at 9%. So present value factors at 9%. Of course, for year 1, it's going to be 1, right? And subsequent years, you can get the present value factors at 9%, guys. What's the present value factor at 9%? Give me the numbers. 9% present value factors. 1 divided by 1.09 to the power of 1. Yeah. So that's 0.917. Then what about second year and the third year? Just check if this 0.842 and 0.772. Correct, guys? Okay. Now, worst case, what are the cash flows? Because it's going to be 1400,000. Okay, so 1400,000. And these are the expected cash flows. So this is going to be 1400 cash outflow in the 0th year. And then in the first year, second year, and third year, we are going to have the respective cash flows as 450, 550, and 650. 450, 550, and 650. Okay. These are the cash flows which is already provided to us. Now we have to get the present values of them. Now we know how to get the present value. It is simply present value factor multiplied by the cash flow. So that's 1400 in the 0th year. Okay. And then this totals up to 412.84 multiplication. 462.92 is multiplication of this, and then 615 to 0.77. So we compute the NPV as 22.31. Right? 22.31 is the NPV. I've taken down the numbers. Okay. 450. It's going to be, guys, year 2, it is 400. Okay. And year 3, it is going to be 700. Okay. Yeah. So this is going to be the NPV in the worst case. Now, in the most likely case, cash flows are initially it is going to be 1400. But in the most likely case, you have year 1 550, year 2 450, and year 3 800. So it's 550, 450, and 800 days. In the best case, cash flows are going to be 1400 negative in the 0th year. Then we have it as 650, 500, and 900. Now, I'll just give you some time to give me the NPV in most likely case and the NPV in the best case. Try it out, guys. Give me the NPVs in the most likely and in the best case. Yeah. Give me the most likely and the best case numbers. Get the PVs and give me the total numbers. Yes, most likely. Obviously, first case, it's going to be multiplied by 1. That is 0th here, it's going to be multiplied by 1. In the subsequent numbers, can you just get me the NPV value for the most likely and the best case? Okay. Most likely case, NPVs are like 0.917 into 550. Then it is 450 multiplied by 0.842. And then 800 multiplied by 0.772. Then it is 100.85. Then in the best case, same way, we can get minus 1400 into 1. Then that's 650 multiplied by 0.917. Then is 500 multiplied by 0.842 and 900 multiplied by 0.77. So just check with the NPV. Just check if you're getting these NPVs, guys. 311.85. That's the NPV in the best case possible scenario. Yes, are you all getting it? Stephen, Sahil, Nilay, Anila, Danya, Karthik, Niranjan, Mamta. Are we all there? Are we getting these NPVs? Usha, Benoja, Abrakesh, Savita, Monica. Yes, are we all there? Morning, good morning. Yeah, just check if you're getting these NPVs, guys. 110 negative, 100.85, 311.85. Okay, so now we have 3 scenarios available with us: worst, and most likely, and the best. And what we observe is that NPV may range from negative 110 till positive 311.85. Right? So NPV may range from negative 110 till the best one, that is 311.85. Okay. So we are getting a possible range of values. So we are getting acquainted that, okay, this is the risk that we have. In the worst situation, we can have a negative NPV also. And in the best situation, we may take 311.85. Now, if I ask you whether the company should invest in this project or not, what would be your answer? What would be your answer? Should the company be investing in this project or not? Yeah. Should the company be investing in this project or not? Tell me, guys. Should the company be investing in this project? Yes or no? I'm not giving you any probability as of now. Just tell me based on this. Just assume that it's an equal probability. Well, sometimes in life, the answer is not black and white, right? The answer is not always yes or no. sometimes you need to be a bit diplomatic, and you have to be in the gray area, or gray zone that we say. So here, if I would be talking from a professional viewpoint, I will say that company uh, should accept this project if it is ready to accept, or if it is ready to take a risk of losing 110.15. If the company is having that capability, I cannot say capability, but the company is having that appetite, that if the company is having that appetite, that it is okay for company to lose 110 in the worst situation, but it's having that risk appetite to take more risk to get a possible higher NPV of 311, then the company should take it. If the company is not having that risk appetite, it should actually avoid these sort of things. Going ahead, I think you have already heard something called as VAR, value at risk. Have you learned this topic, value at risk? I don't know if it is done or not, but there, we specify that this is the maximum loss that an entity can take. Value at risk, how much value is at risk. So in this situation, in this case, you can say the company is having a value at risk of 110.15, because it can lose 110.15 with the respective probability that you can assign to the worst case, right? So if you're ready to accept that level of value at risk, then you should take the project. And if it's not, then you should not take the project, right? So sometimes you need to be a bit diplomatic in your answers also, professionally also, when you're dealing in your corporate life, in your articleship, and even in your business days. You need to be somewhere not always yes or no. You will always try to give professionally decent advice to anyone who is asking for the solution, right? So that's the three possible scenarios. We are having three different scenarios: worst case, most likely, and the best case. Now, one more thing is expected in the question, which says, if it is certain that the most likely situation is going to happen in 2 years, but the situation is uncertain in the third year. So third year situation is uncertain, and therefore we would like to take the worst case scenario. So then in that case, how do we compute the NPV? So let me just add one more column over here. Okay. So it is most likely in year 1, 2, and worst in year 3. Okay. So if this is the scenario, we would like to say, so cash flows are expected to be, most likely number in first 2 years. So of course, initial year, it's going to be 1400. But then first year, we're saying we are likely to get the most likely number. Most likely cash flow is expected in the first 2 years. So first 2 years, we take the most likely numbers, which is 550 and 450. And in the last year, we are not sure about what is the likely case. So if it's, we're not sure about the likely case, then we look at, what's the worst thing possible. So we take the worst cash flow in year 3. Okay. Now, give me the NPV in this situation, guys. Give me the NPV if this is the situation that we're expecting. If you're expecting most likely situation in 1 and 2, in year 1 and 2, and the worst situation in year 3, then give me the numbers, guys. Give me the NPV. Calculate the NPV and tell me the numbers. Yep. So that's going to be 1400 into the present value factor. Then it's going to be 550 into 0.917. Then 450 into 0.842. Then 500 into 0.77. Then of course you can just take a total all of this. So that's 23.65. That's the NPV. Are you all getting this NPV? Yeah. Most of you have answered this. 23.65 is the situation is the NPV possible when you're looking at mediocre or the most likely situation in the initial 2 years, and then worst situation expected in the third year. Are we clear with this question, guys? Yes, everyone? Scenario analysis, we have just created 3 different scenarios. And for each of these scenarios, we are looking at the NPV. So that gives us a range of NPVs that we can have. Now, professionally, when you're doing it, practical life, when you enter the corporate world and try to do this sort of decision, you're not going to be constraining yourself to only 3 scenarios like this, because now this situation is like where you are doing it in a pen paper mode. So there is a limitation, right? You have a limitation where you can do the worst, most likely and best, or maybe 2 more cases. But in real life situation, we will have n number of such scenarios, and of course there we are going to compute the NPV for each of those possible situations, right? So that's the practical aspect of it when you are going to do it in your real life. There, of course, you cannot do it in pen paper. You will need specialized software to look at the possible values of NPV for multiple future scenarios. Okay. Are we good with this question, everyone? Yes. How discount rate is calculated in practical life? Sumit, discount rate is the cost of your capital. You're aware of cost of capital, right, Sumit? So cost of capital is taken as a discount rate. Okay. Yeah. Okay, guys. So that brings us to the end of the scenario analysis topic. Then after that, we have Monte Carlo simulation, but I'll take it up at a later stage to make you understand what is Monte Carlo simulation. That's nothing but an extension of scenario analysis where you're looking for multiple possible scenarios, right, with different degrees of probability and all such aspects. Right now, it's time for us to go for the next tool, an interesting tool called as decision tree analysis. Decision tree analysis. Have you heard of this term, decision tree, anytime, guys? Have you heard of this term, decision tree, anytime? Yes. Not in my session, but anytime earlier during your graduation or in your mathematics or statistics paper, you might have done something called as decision tree, right? So that is now going to be getting combined with that of capital budgeting, and that's going to be a part of our discussion in the next possibly an hour. Okay. So decision tree analysis. When you take any decision, it will have implications, obviously, right? Now, the implications may be very certain or implications may not be very certain. So you may have possible that if you do certain activity now, going ahead in future, possible that you may end up with 2 different situations. And then when you have a second situation, you are going to decide whether I should take it forward or not, right? So you are going to define the investment, then what all alternatives you have at every node, at every point of time, you'll have different alternatives to deal with. So those alternatives will be taken care of, right? And then at each of the node, at each of the decision, at each of the point, you have to take a decision whether should I go ahead with the project or not, whether should I take it up or not, right? So that is what the decision is, what we are going to look at. Now, the more I talk about it, the more confusing it will become. But it is rather better to look at this problem, look at this analysis with the help of a practical example. Okay, so let's get started with this question number 10 to essentially understand how a decision tree or what a decision tree would literally look like. Okay, so let's look at this question. L&R Limited wishes to develop new virus cleaner software. Okay, so we are trying to develop a new virus cleaner software. Essentially, we are looking for a project. Okay, the cost of the pilot project would be 2,40,000. So this project will require us to invest 2,40,000 today. Okay, to invest 2,40,000. Presently, the chances of product being successful launched on a commercial scale are rated at 50%. So this pilot project, it's going to be launched at a cost of 2,40,000. But can I say that project may be successful or it may be a failure? So what are the chance of it being success? 0.5, right? 50% chance is the probability of success. What will be the probability of failure, guys? If you have 50% chance of success, what will be the probability of failure? Of course, 50%, right? Of course, it's going to be 50%. So we can say either at 50% it will be successful or 50% it will be a failure. In case it does succeed, now you are at that node where it is getting succeeded. If it succeeds, L&R can invest a sum of 20 lakh to market the product. So once it succeeds, now it's upon you to invest additional 20 lakh, right? To invest additional 20 lakhs. And on that 20, how are we going to utilize the 20 lakh? The 20 lakh is going to be utilized for marketing the product, for selling the product, for advertising, right? Now, it's not necessary, that the marketing will actually lead you to actual sales. Am I right? Am I right, guys? Is it necessary that you start marketing a product, you start advertising a product? Is it necessary that the product is going to be sold, in that many number of units as you are expecting? Are you sure that if you market the product, the sales, are going to increase by certain percentage? It's possible. It may not be possible also. There also we have different nodes. There also we have different scenarios. So L&R is going to invest this 20 lakh to market the product. And if that marketing activity is going to succeed, right, such an effort can generate perpetually an annual. So now you can say such an effort can. So can means it's one of the possibility that it is a success and you start generating 4 lakh revenue every year till perpetuity. And if such commercial launch, if the commercial launch fails, like over here, if after marketing the product, if the commercial launch fails, there's not much great response from the market, they can make an investment of smaller amount of 12 lakhs. So if it fails, you need to invest additional 12 lakh and that will give you a sum of 1 lakh till perpetuity. So we are going to evaluate the proposal adopting a decision tree approach. The discount rate is 10%. Okay. Now, let me just draw the tree diagram, right? So before that, I'll just give you 10 seconds. Quickly go through the questions, try to memorize, try to just summarize in your mind what is happening, and then we will try to do it in the Excel or the pen paper. Just go through the question once again, yes. 10-15 seconds, read the question once again, try to visualize what situations are trying to arise, and then we will start with the solution. Yeah, shall we begin? Yes, everyone. Okay. Okay. Now, let's try to prepare the decision tree over here. First point, today we are going to have whenever you have a choice, remember, whenever you are having a choice, you are going to have, we follow a norm, we're going to have a box like this, okay? So just keep a note of it that whenever it's a decision tree, we'll use a box to denote that it is a node where we have to take a decision, right? So this is going to be our decision node representation, okay? And after decision, whatever is going to happen, that is going to be represented by circle. Now that circle means this one, yeah. So circle means that it is going to be the outcome node. Okay, so this is the outcome or the possible chance node. Okay, so just follow these what we say nomenclature or the ideas, other convention when we are drawing the decision tree. So the square indicates that these are the decision node. The point, the circle indicates the outcome node. Okay, so I may be using this square and circle. So just before you get distinguished, before you get confused, I thought let me just give you the conventions. So let's get started. First, you wishes to develop new virus cleaner. So our decision is whether to develop the virus cleaner or not. So should I start with a square or should I start with a circle? Should I start with a square or with a circle, guys? Tell me. I have to decide whether I should be, taking up the project or not. So of course, it's going to be square, guys. Perfect. So it's going to be a square, right? Now here I have to decide whether I should be, accepting a project. I mean, whether I should be doing the software testing or not. So there we have got two possibilities, right? There we are having two possibilities whether to take it or not. So the first thing that we can think of is whether to test it or not, right? And of course, once we know that whether to test it or not, we'll have two possible outcomes. If yes, we are going to test it. If not, we are not going to do anything. So first case is, we are going to test it, right? So if you are going to test it, what will be the cash outflow that I need to pay? Can I say 2.4 lakhs? So I'm going to pay 2.4 lakhs if I'm going to test it, right? And if it is the other case where we are not going to test anything, so there's no outflow at all. Okay. After testing, we may find that it is successful or it is a failure. So what should I place at this end? Should it be a circle or should it be a square? Should it be a circle or should it be a square, guys? Over here, it should be a circle because we want to know the outcome. We want to place the outcome over here. So we place the outcome. Okay. So outcome from here, from this point, after testing, we can say either we can get success or we can get failure, right? So again, here we'll have a node. Either we will get the success, right? Or we may face failure. Right? So we have got two outcomes. From this node, we are getting two outcomes. So this was, let's say, node A. Yeah. This is node A, and then we have this over here, possibly I'll write it. Then from here we are having, this is our node B, right? Okay, so at B, we can face either a success of the test, or you can either face failure of the test. So if it turns out to be successful, what is the next course of action? If it turns out to be successful, now of course success means we are talking a probability of 0.5. So we are likely to face a success with a probability of 0.5, and also we are likely to face failure with again 0.5 probability. What do we do if we are getting the success? What does the question say? If we are successful, what is our next course of action? Right? In case it does succeed, L&R can invest a sum of 20 lakhs to market the product. Now for us, it is like we want to, invest 20 lakhs for marketing the product, and such effort is going to give us perpetuity cash inflow of 4 lakhs, perpetual cash inflow of 4 lakhs. So the next thing is, if this really succeeds, then I have a choice over here, right? I have a decision to make, whether I should be investing additional 20 lakh, or I may even refrain that, okay, I don't want to invest. It's quite possible, right? So if we are going to this node, what should be the figure over here? Should it be a circle or should it be a square? Should it be a circle or should it be a square, guys? Because at this node, after the outcome is done, we are going to decide whether to invest or not further, right? So that's again a decision node. So let me just place a circle. Right? Not circle, sorry, square. And here again, I have got two choices. Either to invest, right? So either we are going to invest it further, or we are going to not be interested in the project and just dump the project as it is. Right? So we have this node now. We have this node C now, correct? A, B is done. So node C. Yeah, at node C, I have two decisions to make. Either we invest 20 lakhs, right? Or we say don't invest. This is a possible two things that we can do. Now, what is the case if we are likely to get a failure? If we get failure, what is our course of action? Even if the commercial launch fails, so if this is going to be a failure, right? So if it is going to be a failure, like the testing part, if it is failure, then even if the commercial launch fails, they can make an investment of smaller amount of 20 lakhs with the hope of gaining perpetually a sum of 1 lakhs. So if you are facing failure over here, what is the possible course of action? Again, you have two choices. Either you are going to invest, right? Either you're going to invest additional 12 lakh, or you're not going to invest at all. correct? So even if it is a failure, we have two choices to make, whether to invest additional 12 lakhs or not. So what should be the figure over here? A square or a circle? What should be a figure over here, guys? A square or a circle? Because here again, we have to take a decision whether I should invest additional 12 lakh or I should not invest 12 lakhs. Correct? So it's going to be a square. Yeah. So we have this node over here. Now let me just name this as D. Okay. Now here again, we have got two choices: to invest it or not to invest. Let me just add this diagram here. Whether to invest or not to invest. So if you're going to invest, this will require an investment of 12 lakhs, or you just dump this project and don't make any investment. So our decision tree is ready, but decision is not yet ready. Wait. Our decision tree is ready, but our decision is not yet ready because we still have to look at whether we should be going ahead with the project or not. Now here, decision has to be taken at every decision node. Okay, decision has to be taken at every decision node. So let us say at decision node C. At the decision node C, what is our choice going to be? At decision node C, I have choice 1 of investing 20 lakhs and getting perpetual cash flows of 10 lakhs, not perpetual cash flow. What is the amount of perpetual cash flow? Yeah, 4 lakh. And getting a perpetual cash flow of 4 lakh per annum. Okay. And of course, the choice 2 is, doing nothing, right? Not to invest. Now, can you tell me, will you make a choice of 1 or 2? Yeah. If you're looking for choice 1, what is the benefit that is expected? What will be the benefit from choice 1? What is the benefit that you have from choice 1? Choice 1, if you're going to invest 20 lakh, right? If you're going to invest in node C over here, if you're going to decide that, okay, I'm going to invest 20 lakh, and that's going to give me a perpetual cash flow of 4 lakh, right? So what's the benefit? What's the net benefit that you're going to get? Can I say present value of perpetual 4 lakh minus 20 lakhs? Can I say this is a benefit that I'm getting? This is a net benefit that I'm getting, right? I'm going to get this 4 lakh till perpetuity. I'm going to get the 4 lakh till perpetuity. And to get that perpetual cash flows, I need to invest today 20 lakhs. So what's the net benefit? What is the net benefit? Yeah. What will be the present value of perpetual 4 lakh, guys? Is the question giving you any rate of discounting? Yes. Discount rate is 10%. So what will be the perpetual value ka present value, or what will be the capitalized value of 4 lakh per annum? Tell me, capitalized value of 4 lakh per annum. Every year you're going to get 4 lakh. So what's the present value of that capitalized value? What's the perpetual value? Can I say it is simply 4 lakh divided by 10% minus 20 lakh. That's going to be the net benefit, right? Because every year, if you are going to get 4 lakh, the present value of all the future 4 lakhs is nothing but 40 lakhs. That's going to be 40 lakh minus 20 lakh. So benefit is basically 20 lakhs. Right? So if you go for choice number 1, you get a benefit of 20 lakhs in present value terms. And if you're going to invest nothing, what's going to be the net benefit number? 0. Net benefit number is 0 lakhs. So tell me, at node C, what is going to be your decision? Are you going to invest 20 lakhs or are you going to avoid the investment? What's the choice you're going to have? Are you going to invest 20 lakhs or is it going to be that you're going to do nothing, sir? Of course, we are going to invest because we are going to get on an investment of 20 lakh, we are getting a net benefit of 20 lakhs. Right? So out of these two, we can definitely say we are making the choice of investment. Okay. So of course, looking at these two numbers, we can say it's better to make an investment. So at node C, our decision is to invest 20 lakhs as it gives positive net present value, you can say. Invest 20 lakh as it gives positive net present value. Okay. Karthik is asking me, it's a total investment to get 4 lakh cash flow. 20 lakh divided by 2.4 lakh nahi hoga. 4 lakh cash flow, 20 lakh divided by 2.4 lakh. That 2.4 lakh is a current situation, Karthik. That is not yet considered. Whether to invest that 2.4 lakh or not, that depends on your decision that you're taking in the outcome in B, and then that B actually depends on C. So we are just going backside. So first we take a decision over here that, okay, we are going to invest, sitting at decision C, sitting at node C, you're going to say whether to invest 20 lakh or not. So of course, your answer is going to be, I will invest 20 lakh because that gives me a net benefit. Now we will go back to B and then go back to A. Is it clear? Karthik? So we're just going backside. It's not that we are going, 2.4, then this, and then this. We are first taking a decision whether we should be investing in C. At node C, what is our decision? Then we will go back and see if what is happening in B and what's our decision in A. Clear, Karthik? Yeah. Okay. So at decision C, we have 20 lakhs as a net benefit. So we can say investing 20 lakhs is a choice that we make at node C. Now come to node D. At node D, again we have two choices. At node D, again we have two choices. At node D, we have two choices. One is investing 12 lakh and getting a perpetual cash flow of 1 lakh per annum, correct? So income of 1 lakh per annum. So then what will be the net benefit? Can you tell me what will be the net benefit of investing? If being at decision node D, are you going to invest additional 12 lakh? Are we going to invest additional 12 lakh or no? Because we want to check the present value of 1 lakh minus the initial investment, which is 20 lakhs. Are we going to invest? First, let us compute the net benefit that's possible. So net benefit that's possible is simply 1 lakh divided by 0.1 minus 12 lakhs. Right? So this turns out to be how much, guys? 1 divided by 0.1 minus 12. So it's minus 2 lakh. So net benefit is minus 2 lakh. And if you're investing nothing, if you're not going to invest this 12 lakh, the net benefit is going to be 0. So what's going to be your decision? When you are suppose at node D, are you going to make an investment of 12 lakh or are you going to just eating 5-star? Are you going to invest 12 lakh or are you going to eat 5-star? Will you eat 5-star or will you invest 12 lakh? So 5-star, do nothing, right? So we're not going to invest in this choice number 2. So of course our decision over here is don't invest. Right? So we'll say don't invest in node D. So when we are at node D, we are not going to make any investment. Okay. Okay. So if we are investing, like at decision C, we are clear, we are going to invest. In D, we are clear that we are not going to invest, right? So we have like node C and D. Action is to invest and यहाँ पे action is not to invest. Okay. Now, what is the NPV? What is the net benefit that we have? At being at node C, we have got a net benefit of 20, right? And being at D, the net benefit is going to be 0. What is the probability? What is the probability that at C, you're going to get a benefit of 20 lakhs? So benefit of 20 lakh is definitely going to be there in D, provided there is a success. Correct? Benefit of 20 lakh is possible, provided there is a success. So success probability is, can I say 0.5? Achha, when is this node D happening? When is this node D happening? When there is a failure, right? When there is a failure, the node D is happening. So we say when we have failure, that has also got a probability of 0.5. So if I ask you, what is the expected NPV? What is the expected NPV after testing? Can you tell me what will be the expected NPV after testing? After you have tested it, after you have spent 2.4 lakhs, how much NPV are we expecting? Can I say it will be probability multiplied by the NPV? So that's going to be NPV multiplied by probability. And then we take a summation. Right? So expected NPV after testing is 10. Expected NPV after testing is 10. Now, our decision again we have to take is, being at node A, whether I should invest this 2.4 lakhs or I should not invest 2.4 lakhs. Being at node A, I have to decide whether to invest or not to invest. So we have a similar rule over here. At decision node A, what is the choice that we have? At decision node A, what is the choice that we have? The first choice is invest 2.4 lakh and get NPV of 10 lakhs. Right? So being at node A, what is the net benefit that you're expecting if you are going to invest 2.4 lakh? Sir, if you're going to invest 2.4 lakhs, we are likely to get a NPV of 10 lakhs. So what will be your decision? Whether to invest 2.4 lakhs for an expected NPV of 10 lakhs, or you should not be investing? Tell me, guys, what will be your decision at node A? Are you going to invest 2.4 lakhs? Of course, invest, right? Because net benefit over here is 10 lakhs minus 2.4 lakhs. So that gives us a net benefit of 10 minus 2.4. So 7.6 lakhs is the net benefit that you're going to get. Right? So we're going to get a possible gain of 7.6 lakh. Right? So net benefit possible is 7.6 lakh. And what if I start eating 5-star? The second choice that I have is to do nothing, invest nothing. Then what is the amount that we are going to get? Of course, we don't have any amount to come to us, so that's 0 lakhs. So what will be our decision at node A? At node A, are we going to take a decision to invest or not to invest? Of course, invest, right? Invest 2.4 lakhs as it can give benefit, or as it can give a net benefit of 7.6 lakhs. Okay. So at node A, you have choice. If you invest, you get a benefit of 7.6 lakh. If you don't invest, if you don't launch the product, then you're going to have a benefit of 0 lakhs. So of course, we are going to go for a positive number, and therefore we are going to invest 2.4 lakh as it gives us a net benefit of 7.6 lakhs. Okay. Is the decision tree analysis clear, guys? Everyone? Yes. So remember, at every decision node, you have to take a choice, whether I should invest or not to invest. Are you all clear? Niranjan, Sahil, Mamta, Danya, Anila, Nilay, Nisha, Nilay. Is the decision tree analysis clear to everyone? Vignesh, Usha, Pooja, Monica. In exam, single page of portrait is not sufficient for decision tree. You can prepare this decision tree. Obviously, I've made it quite large. You can make it in a shorter form also. Mamta is asking, can I give direct decision at node A? No, Mamta, you cannot. Because at node A, you need to know what is the benefit that you're going to get from here. And to know what is the benefit coming from here, you need to see what is happening in C and D. Okay, you cannot just give the decision over here. There has to be always a background working. Okay, because how will you decide whether to test it or not? Because whether to put 2.5 lakh, 2.4 lakh or not, you will see whether I'm going to get any future benefit or not. If I'm not likely to get any future benefit, of course, I'm not going to choose it. Am I right, guys? Yeah. Shall I wake you up now with a surprise? Shall I wake you up with a surprise? Yes, everyone? Chalo. In between, just to wake you up, 5 MCQ questions, guys, for you. You can see on the screen, there are 5 MCQ questions. Let's take them one by one. Yeah. What will be the correct option for question number 1, guys? Come on, question number 1. Give me the answer. You've got 2 minutes for question number 1. Let me see how many of you can really answer this. Question number 1, guys. Let me see. 2 minutes time for you. Let me see. It's 806. At 808, I think we should be able to get the answer. Let me see how many of you can do it. Are you solving it? Are we solving it or just waiting for me to get it solved? Solving, right? Good, good. Sure, try it out, guys. It's a really good question. Just one more minute. Okay, shall I start, guys? Shall I start? Okay, let me solve this for you. It's a quite tricky question. Okay, so it says the project involves an initial capital outlay of 10 lakhs. So we're going to invest 10 lakhs, which will give you a single cash flow of 20 lakhs in the nominal terms in year 5. If the real rate of return is 4%, what is the inflation rate if the project leading to an NPV of 2 lakhs? Okay, so if this is a situation, we can simply say that NPV is 2 lakhs, right? So we first need to get the rate of discounting, right? So rate of discounting is simply going to be, we know NPV is nothing but capital outlay of 10 lakh plus present value of 20 lakh. So 20 divided by 1 plus R raised to 5 should be equal to 2 lakhs, right? Because that's going to be the NPV. So first we need to get, this as 20 divided by 1 plus R raised to 5 is 12. And then we say it as 20 by 12 is equal to 1 plus R raised to 5. Now, how much is 20 divided by 12? 20 divided by 12 is 1.666. That's equal to 1 plus R. Then this 1.66, it's raised to 5. So we need to first get 1.6667 raised to 1 by 5 equal to 1 plus R. So the fifth power or the fifth root is going to be 1.1076 is 1 plus R. Okay, so 1.1076 is 1 plus R. So R will be 10.76%. So rate of return is 10.76%, at which you would have computed the NPV. Now we know, now this is of course the nominal rate. Okay, this one is the nominal rate, right? How to solve the fifth root? That is a calculator trick. I'm not sure if you have learned it or not, right? So calculator trick, you have to do 12 times root and all. I'm not sure if you have done it or not. You can, if time permits, at the end we will discuss that. Okay. So R is equal to 10.76. That's the nominal rate. Now, once we have the nominal rate over here, can I say 1 plus nominal rate is nothing but 1 plus real rate into 1 plus inflation, right? So 1 plus nominal rate, so it is like 1.1076 is equal to 1 plus real rate is 4%. So I can make it as 1.04 into 1 plus inflation rate. Now we can just divide it. 1.1076 divided by 1.04. 1.1076 divided by 1.04. That gives us 1.065 as 1 plus inflation rate, and therefore inflation rate is 6.5%. Can we use the option to solve this question on calculator? Yes, you can. Definitely, you can use the option also. I mean, you can try the options and try get the number which matches with the question. So 6.5% is the inflation rate. Did we understand it? Are we getting this question, everyone? Not the question, but the solution, guys. Correct? Okay. That's great. Now, let me just do one thing. Let me just pull out this entire part. Yeah. And okay. So now let's go for some more additional, some more again MCQs. So this was 6.5%. Okay. Now, question number 2, guys. Tell me, what would be your answer? This you should be able to get within a minute. Try to answer this question number 2. What will be the correct answer for question 2? Correct answer for question 2, guys. Cash flows from a project can vary depending on the situation in future years. The probabilities for very favorable, favorable, mediocre, unfavorable, and very unfavorable situations are 0.15, 0.25, 0.35, 0.15, 0.10. What's the probability of favorable situation throughout the project of 3 years if cash flows are dependent? If cash flows are dependent, the probability is asked as a favorable situation. So favorable, this is what we have done in the last class, guys. If you remember, if it's favorable situation and cash flows are dependent, then the answer is going to be, of course, 0.25. So 0.25 is the correct option over here because they are dependent, right? So once you have a favorable situation in 1 year, all the subsequent years are going to be favorable over here. Okay, then let's go for the next question number 3. Yeah. Question number 3. It was, okay, 6.5. Yeah. Question number 3, guys. Tell me, what would be the answer for question 3? Question 3. The probabilities again remaining same. What's the probability for favorable situation in year 1 and 2 and unfavorable in year 3 if cash flows are independent? So if the cash flows are independent, like first 2 years, you will have favorable situation. So first 2 situation favorable means it's 0.25, right? So you'll have like 0.25 for 2 years, and in the final year, it's going to be unfavorable. The unfavorable is having a probability of 0.15. The correct option is option D. Did we get it? Question 3. Did we get it, guys? Yep. Okay. Then let's go for next, 4th question. Which of the following is not a technique to measure risk in capital projects? Risk in capital project. Of course, yes, inflation adjusted NPV, because standard deviation is a measure of risk, coefficient of variation is a measure of risk, sensitivity is also a measure of risk because you are trying to identify which of the variables is most significant or having a greater impact on your project. So you're likely to get an idea about how much negative NPV you can get. But whereas inflation adjusted NPV is just discounting your cash flows, taking into account the inflation rates. Okay, then question 5. In sensitivity analysis, we calculate the revised NPV by taking impact of change in variable that leads to dash change in NPV. What change in NPV? Higher, lower, adverse, or favorable? What impact on NPV do we look at when we are looking at sensitivity analysis? Of course, we are looking for adverse impact on the NPV. So correct option over here is option C, which is adverse. Answer for question 3. Yeah, so for the first 2 years, you're having a favorable situation. So favorable situation is having a probability of 0.25. Right. So first year you will have a 0.25 probability of favorable. Second year you have a probability of 0.25. And third year you are having a probability of 0.15. So third year the probability is turning out to be 0.15 here. Okay. Great. Fantastic. Briefly explain the fifth point. Adverse impact. Because when you're changing the sensitivity, when you're looking for variable, as you are looking at by what percentage your NPV is going to get impacted adversely due to a change in the project or due to change in the variable of the project. Right. So in the question also we did that 2.5% impact by reducing the sale price, by increasing the variable cost. So we're looking at what are the possibilities, you will be facing a negative or a lower NPV, not negative, but lower NPV. Clear, Karthik? Okay. Good. So we have done up to decision tree. Theoretically, conceptually, we have covered up to decision tree. Now it's time for us to take up a new and interesting risk analysis or advanced capital budgeting tool, which is replacement. Break. Sorry, Sumit. Not a break now. We'll take a break after we are done with one more concept, which is this replacement decision. Okay. Once replacement decision is done, then we will take a break and then come back for just one more concept pending and then few questions we will be solving. Okay. Okay. Now, replacement decision. Replacement decision. Now, I think you might have done one or two questions at your CA inter level when it comes to decision about replacement. So here, like two aspects when we are looking for replacement decision, two things are we are going to observe replacement decisions. First aspect is to decide whether to replace an old equipment with new one, right? That's the first type of questions that we are going to look at. So we are going to decide whether we should replace an old equipment with a new one. And the second thing that we are going to discuss is, decide what should be, what should be the replacement. Decide what should be the replacement tenure of an equipment. Okay. So basically, first set of questions we'll have is deciding whether to replace an existing equipment with a new one right now. And the second type of question that we'll observe is at what frequency, at what time interval should an equipment be replaced, right? So like, should I replace this equipment every 5 years or every 3 years or every 8 years? That decision is what we are going to look at in this second type of question. Now, first type of question, it involves some basic knowledge about the capital budgeting thing, right? It's we are going to decide to replace an existing machine with a new one only if the net present value of the replacement is positive. So if our NPV is positive, we are going to replace it. If the NPV is negative, we are not going to replace it. Simple. Okay, so simple, we have to calculate the net present value, but then there we have to think a lot, think a bit that no, we're going to look at incremental basis. If I'm going to replace an existing machine with a new one, what are the benefits and the costs that I'm going to have from that particular decision? If the net present value, if the present value of benefits exceeds the present value of cost that I incur, then of course we are going to accept the replacement decision, or else we are going to take it, or we are going to say that we are not going to replace it right now. So simple decision to calculate is to calculate the NPV. Now let's just understand this more with the help of a question, which is this question number 11. Okay, a company named Robbie's Cube decided to replace the existing computer system of their organization. Original cost of the old system, okay, original cost of the old system was 25,000. So remember, we have purchased this old system for a price of 25,000 5 years ago. So we have got this system 5 years ago at a cost of 25,000. Second is, current market value of old system is 5,000. So today, if I am going to sell this old equipment, old computer system, I'm going to get a salvage value or a scrap value. I cannot say salvage or scrap, but a sale value of 5,000. Now, in our books, depreciation was provided. Depreciation of the old system was charged with a life of 10 years. So that 25,000 was depreciated over a period of 10 years with estimated salvage value as nil. So can you tell me what will be the amount of depreciation every year of the old system? So what will be the amount of depreciation per annum? What will be the amount of depreciation per annum from the old system? Can I say it will be 25,000 divided by 10, which is 2,500. So originally, the equipment that we have, that is, that's we are getting depreciated in our books at a price of 2,500. Then depreciation of new system will be charged with life over 5 years. So the new system will be charged as a depreciation over a period of 5 years. So new equipment is going to be depreciated over a period of 5 years. Present cost of new system is 50,000. Estimated salvage of the new system is 1,000. Can you tell me what will be depreciation on new equipment? What will be the amount of depreciation on new equipment? Depreciation on new equipment. Can I say it's going to be 50,000 minus 1,000 divided by 5. 50,000 minus 1,000 divided by 5. So that's like 9,800. So old equipment, we are getting a depreciation of 2,500. Now we'll be getting a debris of 9,800. Okay. Estimated cost savings with the new system is 5,000 per year. So this new system is going to give you a cost saving of 5,000 per year. And also increase in sales with new system is assumed to be 10% per year based on original total sales of 10 lakh. So what is the per annum incremental benefit that you're going to get from this new equipment? What's the net benefit? What's the incremental cash flow that you're going to get from this new equipment every year? Can I say 10% of 10 lakh? 10% of 10 lakh. How much is it? 10%. Is it 10 lakh or? No, this is 1 lakh. Sorry. This is 1 lakh. So comma has been placed inappropriately. One second. Let me just do one thing. Yeah, so this is 1 lakh. So original sales is 1 lakh. And on that 1 lakh, of course, we are going to get a benefit of 10 lakhs. So what will be the benefit that we are going to get? What is the extra sales that we are going to have? 10,000 extra sales, right? Company follows a straight line method of depreciation. Cost of capital of the company is 10%, whereas tax rate is 30%. So idea over here is very simple. Simply take the present value of future cash flows and subtract it with the present value of future cash outflows, so inflows, right? We're just going to calculate the NPV over here, nothing great in it. Just we need to be a bit mindful of what sort of benefits and cash flows are we going to have. So let's look at the first case. First, let us understand, we know that there is going to be a benefit, that we are going to get, we'll say, what is the incremental cash inflows from, or incremental cash inflows per annum from new system. So from the new system, what is the incremental cash inflows that we are going to get? Two things. We're going to get two things in it. First is incremental sales plus incremental savings minus incremental expenses if there are any, and not to forget one more important aspect. What's that one more important aspect? Tax saving on tax savings on incremental depreciation, right? So we have to compute these aspects. First is incremental sales plus any incremental savings minus any incremental expenses plus the tax savings on the incremental depreciation, right? So let's try to compute it. First one, incremental sales. How much is the incremental sales? What is the additional sales that we are going to get from this project? Additional sales, guys, tell me. What's the additional sales? Can I say it is 1 lakh multiplied by 10%, which is 10,000, correct? Then what is the incremental savings? Are there any incremental savings in the question? Are there any incremental savings in the question? Yes. Yeah. So estimated cost savings with the new system is 5,000 per year. So that's 5,000 for us, correct? Are there any incremental expenditure that we need to do in this project? Any incremental expenditure? Any incremental expenditure? No. Now we just need to add over here tax savings from incremental depreciation. Tax savings from the incremental depreciation. Now, how much is the tax saving from incremental depreciation? So for that, we'll say old machine depre per annum. How much was the old machine depreciation per annum? We have computed it, right? Old machine depreciation per annum was 2,500. What is the new system? Machine or system? Okay, system. Old system depreciation per annum was 2,500. New system depreciation. What's the new system depreciation per annum? They've computed it, right, guys? What's the depreciation from new system? 9,800. So what is the incremental depre per annum? So incremental depre is 7,300. So due to this additional depreciation, are we going to save taxes on this? Yes or no? We're going to save taxes on this, right? What's the tax rate given? What's the amount of tax rate? Tax rate 30%. So it will be 7,300 multiplied by 30%. Right. So that gives us a depreciation, incremental depreciation of 2190. So this 2190, is it going to be cash inflow or cash outflow? 2190, is it going to be cash inflow or cash outflow? Inflow, right? So there is an inflow of 2190, right? So if I ask you, what's the overall impact in cash flow per annum? Net cash flow or net incremental cash flow, I can say. Net incremental cash flow per annum from new system. How much is the total inflow that we are going to have? Can I say sum of all of them? Which is going to be 10,000 plus 5,000 plus 0 plus 2190, right? How much is it? Is it 17,190? Can I take 17,190? You're forgetting one thing, guys. Incremental sales and savings. How can we take it before tax? Yeah. This also has to be considered after tax, right? Basics of capital budgeting, after tax cash flows. So 10,000 is additional sales that you're going to have, but that is not your entire cash flow which you'll be getting, right? Shouldn't we take the after tax impact of it? Correct, guys? So incremental sales, of course, this is post-tax number. This has to be incremental sales or after-tax number. So we are going to take whatever is the extra sales, that's an extra income for you, right? And whatever is the savings that you have, that's an extra income. That's again an extra income for you. So on that, if we have to take it as a additional, tax. Had it been given as a expense, I would have subtracted the expense and then taken the post-tax, right? So these things has to be taken post-tax. So we'll say total cash flow before savings in, before depreciation saving, before depre impact. Before the depreciation impact, we have the savings total of 15,000, right? 15,000 is an additional inflow for us. So what will be the after tax cash flow? After tax cash flow will be 15,000 multiplied by 0.7, right? So 10,500 is the after tax cash flow before depreciation impact. Right? So overall, my income is going to increase by 15,000 before giving the impact of depreciation. So overall impact is going to increase by 15,000, but that 15,000 will be obviously subjected to tax. So after we subtract the tax effect, we get the after tax cash flow will be 10,500. So it will be 15,000 into 0.7. That is after tax number. So 10,500 and the tax saving due to depreciation. So this total will be 10,500 plus 2190. So 10,500 plus 2190. We said 12,690 is the net incremental cash flow per annum from the new system. So from the new system, every year we are going to get a net cash flow per annum of 12,690. Got it, guys? Did we get it? The after-tax impact of the net cash flows and also the tax savings on the depreciation. Is this clear? Everyone, net incremental cash flow from the new system, 12,690. Rakesh is asking, why tax saving on depreciation is 30%? See, depreciation 7,300 is what you're going to claim. On that, 30% will be your tax saving. If you're doing 1 minus 0.3, that will be after tax cost of depreciation. We don't want after tax cost of depreciation because depreciation is not my cash outflow. I want what is the tax savings due to depreciation. So that will be depreciation into tax rate. Okay. So when we are deciding whether to replace some equipment with a new one or not, simple thing is check what are the cash inflows from the new system. Due to the new system, you will have an incremental sales of 10,000. You will also save 5,000 on your other expenses, and there is no other expenditure that you are incurring. So your cash flow before depreciation impact will be 15,000. Now on that 15,000, right? On that 15,000, you are going to pay tax because this is a additional profit that you are making, right? Your additional profit that you're making 15,000. So that 15,000 into 0.7 will be the after-tax cash flow before the impact of depreciation. On that, we add the tax savings on depreciation, which is the incremental depreciation tax saving. That gives us a total 2190 plus 10,500, which is 12,690. Is this part clear now? 12,690. Is it clear? Yeah. Yeah. Savita, in the earlier working, we haven't considered the after-tax effect. We have just taken 15,000. So I need to deduct the tax that I need to pay on it, right? So that tax has to be deducted, and then net cost for you will be 10,000. Net savings for you will be 10,500. Earlier, when we were doing this 15,000, only 15,000, we didn't consider the tax impact of this. Got it, Sarita? Yeah. In the previous working, we didn't have the tax impact. Tax was not given due consideration to this. Okay. Fine. So we have the net incremental cash flow per annum from the new system. Now, we have to compute the NPV. So for NPV, I need to know what is the, obviously we got the first aspect over here. Now the second aspect we need to get is what is the investment that I need to make, right? So calculation of, we'll do the calculation of cash investment or initial calculation of cash outflow, calculation of cash outflows towards acquiring new system. What is the cost of new system, guys? What is the cost of new system? At what price are we getting the new system? 50,000, right? But is it 50,000 cash outflow that I'm going to have today if I'm going to replace the old machine with new? Is it 50,000 cash outflow that we are going to have? No, right? Because there are other aspects also. So cost of new system is 50,000. From that, we are going to reduce less sale value of old system. So the old system that we have, can I say we're going to replace it? So we are going to sell it off. So what is the price at which we are going to sell the old system? What's the price at which we are going to sell the old system? 5,000, correct? So can I say I need not pay entire 50,000, but rather I'll be paying only 5,000. Okay. One more impact is I need to know what is the book value of this asset as of now in our books, right? So book value of the asset that we have as of now in our books, and what is the sale value. So on that, tax saving will be there. So we'll say cost of old asset 5 years ago. 5 years ago, we have purchased the old asset for 25,000, right? 5 years ago, we have purchased the old asset for 25,000. Then tell me what is the amount of depreciation till date? How much is the amount of depreciation that we have charged till date? Can I say 2,500 into 5? So 12,500. So what is the WDV of old today? Can I say 12,500? WDV, can I say it is 12,500? So WDV is 12,500. And what is the sale value? Sale value of old asset. At what price are we selling the old asset? 5,000. So do we have a gain on sale or do we have a loss on sale? Now, I don't want you to bring your short-term capital gain concepts over here right now. We are just going by the common commercial sense that how much is the gain or loss that we are going to have, right? So what's the gain? Is there a gain or a loss? There is a loss on sale, right? Loss on sale. So loss on sale is 7,500. Okay. What do you think? What will be the impact of this loss on sale? From the taxation point of view, will there be a tax saving or will there be an additional tax? Tax saving, correct? So we'll say tax savings. Tax savings from loss on sale. What will be the tax savings on loss on sale? Can I say it will be 7,500 multiplied by 30%? This is what you're going to save. So can I say, we'll just add over here tax savings from loss on sale of old. So tax saving is 2250. Right? Tax savings are not notional, tax savings are real, because we are going to save this 2250 today because we are going to sell the asset. I'm not bringing in income tax law right now. I'm just making you understand from a pure commercial sense. Right? So 2250 is the tax saving that we have. So what will be the net cash outflow in year 0? Net cash outflow in year 0 will be a total of all of them, right? So 47,250 is what we are going to invest today. So we are going to invest 47,250 today. And every year we are having a cash inflow of 12,690 for the next 5 years, right? Because life of the new machine is going to be 5 years, correct? So now I have to get the NPV. I have to get the NPV. So I can say net present value of replacement decision will be 12,690 multiplied by present value annuity factor at, what's the rate? 10% for 5 years. So 12,690 into present value annuity factor at 10% for 5 years. Add to it 1,000 into present value factor at 10% for 5 years. Okay, help me with the present value factors, guys. What's the present value annuity factor at 10% for 5 years? Present value annuity factor at 10% for 5 years. What's the number? Present value annuity factor at 10% for 5 years. 3.79. Okay, 3.79. Add to it 1,000 multiplied by, what's the present value factor at 10% for 5 years? 0.629. Okay, 0.621. Okay, so we then simply say that it's 12,690 into 3.79 plus 1,000 into 0.621. Okay, sorry, why should I take 1,000? That's going to be 47,250. Right, so 47,250, or rather I can say this is going to be a minus number, because that's 47,250 is an investment, right? And here also we'll say this is 47,250. Yeah, minus 47,250. One thing is left out, because there is a salvage, right? We have a salvage from the asset, right? So net present value is what we are computing. So I need to also consider plus salvage of 1,000 into present value factor at 10% for 5 years, right? So that will be 12,000 into 3.79 plus 1,000 into 0.621 and then minus 47,250 for the last year. So when we do that, plus 1,000 into 0.621. Is it? 1 second. 57. What is this being done? Sorry. This will be just 47,250 subtracted. That's the initial investment now. Okay. 621 will be there. Yes. Some problem. 1 second. I'll just avoid this and simply do it in a better way for you. Let's write down simply the year, right? It's always better to have this in tabular form. Year, cash flows, PV factor, and the PV. Simple. Year 0, we have an outflow of 47,250, right? Is 50,000 minus sale of old value. 2250 is the tax saving. Yeah, 1 second. 1 second. There is some issue. 50,000 is the cost of the new system. We are purchasing sale value of old machine is 5,000, and then the WDV is 12,500, and we are selling it for 5,000. So there is a loss on sale which is 2250. So 47,250. Yeah, this is the net cash outflow. So initial 0th year it's 47,250. Then from year 1 to year 5, we are going to have a cash inflow of 12,690, and then in the 5th year 1,000 cash flow. So PV factor over year 1, this was 3.79, right? PV factor, I mean present value annuity factor for 5 years. Is it 3.79 at 10%? $3.79. Okay, and the last one is 0.621. So PV will be cash flow multiplied by the PV factor, and then we simply take the summation of this. So 1466 should be the present value. Yeah, Nisha. You can wait. I'll let you unmute, Nisha.
So tax saving on the sale is being reduced, right? But you've added it in the sum to arrive at 47250. It should be reduced, no, sir?
Okay, yeah. It should be reduced. Correct. Yeah, reduced. Correct.
Thank you, sir.
Yeah, so there was a correction bit. Okay. Yeah, so tax saving should be reduced because that's a inflow. Because it's going to cost us 50,000 the new system. 5,000 will be the sale value of the old that we are going to receive, and also we are going to save 2250 tax from the sale of old. So that has to be subtracted from our cost. So that gives us a net present value of 5966.1. So based on this NPV, can you tell me we should be accepting the project or should be rejecting the project? I mean, should we replace the machine? Should we replace it or we shouldn't replace it? Should we replace the machine or should we not replace it? Of course, replace it. Right? We'll say replace the system with new one as NPV is positive. Okay, are we good, guys? So replacementing, two-stage answer has to be given. The first thing is you need to first calculate the incremental cash flows, which will be incremental sales plus incremental saving minus incremental expenditure, make it post-tax, add the tax savings due to the incremental depreciation. That becomes your incremental cash flow per annum from the new system. Then simply calculate the NPV. But one peculiar attention is that in 0th year, when you're going to buy the new asset, you're going to sell the old asset. So sale proceeds needs to be subtracted, and also tax savings or additional tax that you pay that needs to be given account. And then that will be your 0th year investment. And then simply calculate the NPV. If NPV is positive, we replace the machine. If NPV is negative, we need not replace the machine. Are we good with this replacement type questions, everyone? Now, this is the first part that we have covered, whether to replace an old equipment or not. Okay, so now let's take a break. Post that, we have two concepts to cover, last pending concepts. One is the replacement frequency, and the second is to calculate the the adjusted present value. Okay, let's take a break, guys. A break of 10 minutes. there? Are you all there, everyone? After the break. Hello. Yes. Okay. Great. Now, the second aspect of replacement decision making is, understanding in what tenure or what frequency should be used to replace a machine or replace any equipment. Should I replace it after every 1 year, or after every 2 years of usage, or after every 5 years of usage? Right? That's what we are going to look at. So to understand that concept, let's go for question number 12. X Limited is a taxi operator. Each taxi cost to the company 4 lakh. Okay, so we are a taxi operator. We have a fleet of taxis, and each taxi is costing us 4 lakh rupees. It's having a useful life of 3 years. Okay, so each taxi is having a useful life of 3 years. Taxi's operating cost for 3 years and the salvage value at the end of the year is as follows. So taxi is having running cost or operating cost. Obviously, when the taxi is new, in the first year, you will have lesser running cost. But as you proceed for year 2 and 3, you will have a greater amount of operating cost, right? And the resale value is definitely going to decrease over a period of time. We are required to determine what is the optimum replacement period. So we want to know whether I should replace the taxi in 1 year, or should I use the taxi for 2 years and then replace it after every 2 years, or should I replace the taxi after every 3 years? Okay, so that's the decision which we have to take, right? So we have to decide based on this that the taxi is going to be replaced whether in a year, after 2 years of usage, or after 3 years of usage. Okay, so I hope the question is clear. I mean, what the question requires us to calculate. Is that clear, everyone? We have 3 choices. Either to replace it in 1 year of usage, like use it for 1 year and then sell the taxi and get a new taxi. Second option is use the taxi for 2 years, sell the taxi and again get a new taxi. Or third is use the taxi or run the taxi for total 3 years and then get it replaced with a new one. So we have to decide whether I should be replacing the taxi after every 1 year, or should I replace it after every 2 years, or should I replace it after every 3 years? Okay, so we have to determine the optimal replacement period. Okay, is the question clear? Because unless the question is clear, we will not get to know what we are really solving. Are you understanding what the question is asking you? Everyone? Question is asking us to determine at what intervals should you replace the asset. Should it be replaced every annual, or should it be replaced every 2 years, or should we be replacing it after every 3 years? So you have to determine the optimal replacement. So how do we do that? We simply calculate the net present value of our decision, right? So let's try to calculate net present value if taxi is kept for 1 year. So we'll try to say what will be the net present value if the taxi is kept for just 1 year. So if the taxi is kept for 1 year, then we have the particulars, cash flows, PV factor, and then the PV. Now, if you're going to keep the taxi for just 1 year, in the 0th year, we are going to buy the taxi, right? So cost of taxi, we're going to buy the taxi. The cost of taxi is basically 4 lakh, right? And of course, PV factor will be 1. So PV will be minus 4 lakh into 1. Then since you're going to replace it after 1 year, so first year you will have a operating cost, right? So operating cost of running the taxi for 1 year is 1,80,000. What will be the present value factor at 10%? Can I say 0.909? And then we say it is cash flow multiplied by PV factor. Then, since we are going to replace, or since we are going to sell the taxi after a year, will I have second year operating expense for the taxi? Will I have a second year operating expense for the taxi? No, because I am selling it. So in the first year, will there be any other cash flow in the first year? Will there be any other cash flow in the first year? Yes. Resale value, right? Sale of taxi. First year, what is the salvage value, resale value? It is 2,80,000, but that will be an inflow. 2,80,000, right? Then present value factor will be also 0.909. And then the present value will be 2,54,000. When we take a sum of it, we get the net present value to be 3,09,100 negative, because it's an outflow. We have not considered the inflow that we are getting from the taxi, because our assumption is, the taxi is going to provide same benefit over a number of years, like the number of amount of fare that you're going to collect is going to be same throughout its life. So this is the net present value if the taxi is kept for 1 year. Now, can you do one thing, guys? Can you calculate the similar net present value? A similar net present value if taxi is kept for 2 years. Can you calculate the net present value if taxi is kept for 2 years? Yes, can we do that? Can you calculate the NPV if the taxi is kept for 2 years, guys? So let's say if you are selling the taxi after 2 years, can you calculate what will be the NPV? Yes or no? Can we do that? Pooja, Nisha, Savita, Karthik, Sumit, Sanya, Nisha. Can you do it? I'll just give you a hint. Maybe year 1, 2, and 2. These are going to be your pattern of cash flows. So tell me the NPV. Please calculate the NPV of the if the taxi is kept for 2 years. Give me the NPV if the taxi is kept for 2 years. It will be negative. All the NPVs are going to be negative here because it's purely talking about the outflow. Inflow is not considered in this case. Yeah. So we'll have like cost of taxi, but you will have operating expense, operating cost twice. And then of course, sale of taxi. So cost of taxi is 4 lakh. When we are operating it for the first year, we need to pay 1,80,000. Then when we are doing it for the second year, we need to pay 2,10,000, right? And when we are going to sell it in the final year, we are going to get a salvage value from the old taxi as 2,30,000. And of course, the PV factors will be 1, 0.909. What's the PV factor for second year? 10%. 10% PV factor will be 0.826. 0.826. And then PV will be cash flows multiplied by PV factor. Right? Check if you are getting this negative 5,47,100. negative 5,47,100. Regarding this NPV, negative 5,47,100. Everyone? Yes? Okay. Same way, can you calculate the net present value if tax is kept for 3 years? Can we do that? Can we get the net present value if tax is kept for 3 years? Okay, sure. Do it, guys, quick. If tax is kept for 3 years, so you need to pay the operating expenses for 3 years. And then in the third year, you'll have a sale of tax. So give me the 3 years NPV, net present value, if the tax is kept for 3 years. One lakh 80, 2 lakh 10. The third year is 2 lakh 38,000. And then sale value is 1 lakh 68,000. Third year PV factor is how much, guys? What's the PV factor for third year? 10%. It's 0.751, right? Yeah. So just check if you're getting the NPV of 7 lakh 89,650 negative if the tax is kept for 3 years. Yes, 7 lakh 89,650, everyone. If the tax is kept for another 3 years, we are going to get 7 lakh 89,650. Yes, okay. Now, based on this, can you tell me what should be the replacement cycle? Should I replace the taxi every year? Should I replace the taxi every 2 years? Or should I replace the taxi every 3 years? Can you decide based on these NPV numbers? Can we decide based on these NPV numbers? Yes or no? And if no, why? Why can't we decide on the basis of these NPV numbers whether we should replace it in first year, second year, or third year? Why can't we decide? All are negative. Obviously, all the cash flows are going to be negative because we are considering only the cost. Inflow is constant. Whether you replace it in first year or second year or third year, every year inflow is going to be same. Right? The idea or the reason why we can't use this for NPV for decision making is each of these NPVs are for different years. They are for different periods. Right? This is NPV for only 1 year. This is NPV if the tax is kept for 2 years, and this is for 3 years. So I cannot take all of them. Right? I cannot compare these numbers and then say whether I should replace it or not. So what we need to do is, since NPV are for different time periods, tell me if NPVs are for different time periods, if NPVs are going to be for different time periods, how do we take a decision regarding the projects? How do we take the decision regarding the projects? If NPVs are different for time periods, how do we calculate the, on what basis do we take a decision regarding the project? Yeah. Average. divide by discounting factor. Since NPVs are different, NPVs are for different time periods, we will need to calculate annualized NPV, that is equivalent annual cost, right? So we need to calculate the annualized NPV or equivalent annual cost. This is what you might have already done in CA Inter chapter of investment decisions, right? Do you remember? You might have done this in your CA Inter investment decision chapter. Yeah. So equivalent annual cost or equivalent annual cost will be calculated as NPV divided by present value annuity factor, right? So like in year one, if we say what is the equivalent annual cost, before that equivalent annual cost, we need to see what's the NPV and what will be the present value annuity factor. Right? So in CA Inter, you might have already done this present value annuity factor thing. So if we are thinking of replacing it in just year one, we know NPV is this number. Then if it is year two, NPV is minus 5,47,000. Then in year three, NPV is minus 7,89,650. Present value annuity factor for 1 year, it is 0.909. What will be the present value annuity factor for 2 years? What is the present value annuity factors for 2 years? Present value annuity factor for 2 years, 1.735. What is the present value annuity factor for 3 years? Present value annuity factor for 3 years, 2.486. So equivalent annual cost will be NPV divided by present value annuity factor. Now, when we look at these numbers, we have this equivalent annual cost. Now, based on this, we can take a call when we should replace the taxi. If you are going to replace the taxi every year, then annualized cost, on an average, your annual cost is 3,40,000. Whereas in second year, if you are going to replace, your per annum cost turns out to be 3,15,000. And if you're going to replace it after every interval of 3 years, then the annuity, equivalent annual cost is 3,17,000. So now tell me, what should be your optimum replacement cycle? Should you replace it at the end of every 2, 1, or 3? Of course, at the end of year 2, right? So you can say taxi should be replaced at end of every 2 years, as it results in lowest equivalent annual cost. Okay. Are we clear, guys? Equivalent annual cost. Yeah, so replacement decisions is done. So we can say taxi should be replaced at every 2 years, as it leads to lowest equivalent annual cost. Oja is asking, since these amounts are still in negative, how can they decide? These amounts are definitely going to be negative, Oja, because these numbers are only considering the outflow. Inflow is constant in all the 3 options. So we decide on the basis of what? Wherever there is a less, wherever there is a lowest NP, wherever there is a lowest negative number. right? So lowest negative NPV is what we are considering, because cash inflows information is not given. So we are evaluating this project only on the basis of cash outflows. Okay, fine. So the last but second concept of this chapter is done. Now we are just left with one concept to discuss, which is the adjusted present value. I have told about this adjusted present value in the first class of mine. I've told something about this adjusted present value. To which concept can we really connect this adjusted present value as? To which concept can we connect this adjusted present value of our CA inter? CA inter, some topic I have named to which this adjusted present value is going to be connected to. No, it's not leverage. Stephen, if initial cost is ignored and present value of annual cost, then ECC is calculate any decision on any, then ECC. I'm not getting you, Stephen. You can ask it towards the end. Okay, I'll make you unmute and then you can ask. Okay, adjusted PV. What was this concept connected to? Anyone? In my first class, I've told you when I was just giving you a roadmap of the topic, a roadmap of the concepts that we are going to do. Adjusted present value was connected to one of the chapters of your CA Inter. Remember, I have told you something called as Modigliani-Miller model. Modigliani-Miller model. Can you recall? MM model, guys. MM model. Remember MM model from CA Inter? MM model was not in cost of capital. MM model was in capital structure theory or capital structure chapter. Not of the dividend. MM model was, I'm not connecting it with the dividend model. I'm talking of MM capital structure. There, you might have learned a formula called as value of levered firm is equal to, complete it, complete this statement. What is the value of levered firm equal to? Value of levered firm equal to what? What was the formula? Value of levered firm equal to? Yes, correct. It is value of unlevered firm plus tax savings on or plus debt into tax, right? This was the formula, right? So value of unlevered firm is equal, value of levered firm is unlevered plus debt into tax. Now, why do we do this multiplication of debt into tax? See, what is the additional benefit that a levered firm has? What is the additional benefit that a levered firm has as compared to the unlevered firm? Because a project, wherever you're investing, the business that you're doing is going to provide you the same amount of cash flow. The business that you're doing is going to provide you the same amount of cash flow, same benefit. Okay. So, what is the additional benefit to levered entity? Additional benefit to levered entity was tax savings due to interest payments. Right? So when you pay dividend to your shareholders, are you getting any tax benefit on that? If you pay dividend to your shareholders, do you get any tax benefit? Do you get any tax savings? Is dividend a deductible expenditure? No, right? But if you have raised money by way of debt and you're paying interest, can I say you get the tax benefit? Correct? You get the tax benefit. So additional benefit that we have to a levered firm is tax savings due to the interest payments, which the unlevered entity doesn't have. If the unlevered entity is paying dividend to its equity shareholders or preference shareholders, it doesn't get the tax benefit. But the levered entity gets the tax benefits because there are tax savings on the interest payment. Now, what will be the tax savings on interest payment? Can I say it will be tax rate multiplied by interest per annum, right? So annual benefit to levered entity. Annual benefit to levered entity is tax rate into the interest per annum, correct? Am I right? Annual benefit to a levered entity is tax rate into interest per annum. Now, if I want to say present value of future tax savings due to debt, present value of future tax savings due to debt, that will be simply interest multiplied by tax. This is a per annum tax saving, right? This is the per annum tax saving that we have. Now, if I want to capitalize it, I should divide it by what? If I want to get the present value of this perpetual cash benefit, perpetual tax benefit that we have, I should divide it by what? To get the present value, I should divide it by what? Can I say cost of debt? I should divide it by cost of debt, right? Because if I want to get the present value of future tax savings, I should divide it by cost of debt. Correct, guys? Yeah. So if I just make a bit change, interest upon cost of debt multiplied by tax rate. Now, what is interest divided by cost of debt? What is interest divided by cost of debt? What is interest divided by cost of debt? Tell me. Can I say interest divided by cost of debt is value of debt? Right. So that is nothing but value of debt multiplied by tax rate. And therefore, we say additional value of levered firm. Additional value of the levered firm is the value of debt into the tax rate. I hope it is clear why we were doing this debt into tax rate. That concept is clear with now. Right? So additional value of levered firm is value of debt into tax rate over and above the unlevered firm. Correct? Am I right, everyone? Now, same we are going to have in capital budgeting also. What we do is we first calculate the present value. We first calculate the NPV by using cost of equity, right? So basically, adjusted PV is nothing but base case PV. Add to that PV of tax savings due to debt. So it's going to be base case PV plus PV of tax benefit on interest. So plus PV of tax savings on interest. Tax savings on interest. So adjusted PV is base case PV plus PV of tax savings on interest. Can I say this additional part that we are multiplying over here, present value of tax savings on interest, is nothing but that's coming from this concept of value of debt into tax rate or additional benefit that a particular project has if it is getting funded by debt. Okay. So now adjusted PV is obviously what we got this. What is this base case PV, sir? Listen. Base case PV is PV calculated assuming project is funded by equity. So present value, if you are going to assume that the project is funded by equity. Let me just take an example for you. Okay. So suppose initial cost of a project is 10 lakh. Okay. Cost of equity is, let's say, 20%. Okay. Cost of equity is suppose 20%. Cost of debt, if the company goes for borrowing, then cost of debt or interest rate, we can say. Let me take cost of debt only. So cost of debt is suppose 15%. Okay. And this project is going to provide you, let's say, a CFAT per annum of 1,50,000. And this is going to be till suppose perpetuity. Okay, let's assume that this 1,50,000 is going to be the cash flow from this project till perpetuity. Okay. Now, can you calculate the base case NPV? What will be the base case NPV? Because base case NPV is what? Present value calculated assuming project is funded by equity. If the project is going to be funded by equity, let me take this as not 1,50,000, but let's take it as 3 lakh. Okay, 3 lakh till perpetuity. Base case NPV calculation. So when I want to calculate the base case NPV, assuming project funded by equity. So base case NPV is assuming project is funded by equity. So how do we get? Can anyone give me the NPV if you are assuming that project is funded by equity? If you are going to assume that project is fully funded by equity, what will be the NPV? Obviously, it will be present value of inflows minus present value of outflows, right? So that will be simply present value of inflow will be 3 lakh divided by 20% minus 10 lakh, right? So that's going to be 3 lakh divided by 20% minus 10 lakh. So we get the base case NPV as 5 lakh. So if this project is assumed to be funded fully by equity, if this project is assumed to be fully funded by equity, can I say the base case NPV is 5 lakh? Because 5 lakh is the NPV which equity shareholders can be looking at. Now, what is adjusted NPV? Adjusted NPV, as we said, it will be base case NPV plus, it will be base case NPV plus, we will add to that present value of future tax savings. So I need to first get this portion, which is present value of future tax savings. So let's try to get the present value of future tax savings. Present value of future tax savings. Okay. How much is going to be the present value of future tax savings? Of course, assuming entire investment is by debt. So if you assume that entire investment is going to be by debt, how much debt are we going to raise? Of course, 10 lakh, right? So before we look for present value of future tax savings, we need to know what will be the interest expense per annum. So that will be 10 lakh. If you are going to fund this entire project by debt, on this 10 lakh, you're going to pay 15% as interest. So 15% on this is 1,50,000. Now, what will be tax savings per annum? Tax savings per annum on interest. What is the amount of tax savings per annum on interest? So we need to get the tax rate. So let us assume tax rate to be 30%. So if the tax rate is 30%, present tax saving on this is going to be 1,50,000 into 30%. So what is the amount of tax savings per annum? Tax savings per annum. This is going to be can I say 45 lakh, sorry, 4,50,000, sorry, 45,000. So how can I get the present value of future tax savings? Present value of future tax savings will be 45,000 is every year tax saving that I need to capitalize. So if I'm going to capitalize it, I'm going to divide it by KD. Now what's the KD? KD is 45,000 divided by KD is 15%. So what's the tax saving that we have from this project? 45,000 divided by 15%. That's nothing but 3 lakh. So we got two numbers. One is if you are going to fund the project fully by equity, the NPV is expected to be 5 lakh. If you are going to fund it by debt, we will have an additional savings due to the interest, due to the tax on interest, and that's going to be 3 lakh. So adjusted NPV will be calculated as base case NPV plus to that you will add 3 lakh as future tax saving. So adjusted NPV will work out to be 5 lakh plus 3 lakh, which is 8 lakh rupees. So it is similar to the model that we have done in our CA intern. Is this concept clear now? Adjusted NPV. Yep. It's just the same thing. You take the NPV by assuming fully funded by equity, and then you take the tax. Yes, Anila, you're right. You can take that also. Okay. So we have covered like all the concepts. There are quite a few questions in the assignment that I have uploaded. You'll find the solutions for them in the module itself. Okay. So in the module itself, you'll be able to get the solutions for all the remaining questions. Okay. So homework questions, yeah, solutions, all of them you will find it in the module only. So whatever is left out as homework for you, you will find the solutions are absolutely there in the module. You can access them from there. Apart from that, if you have any queries to ask for, you can do it right now. So we are open for the query session. Any queries?
अशोक जी एक्सेस दे दीजिए बच्चों को. Students, if you have any query, please you are free to ask here.
Good morning, sir.
Good morning, Savita.
सर ये MCQs के लिए प्रैक्टिस हम कहाँ से करें?
Okay, I tell you. But we have a portal. Okay.
हाँ जी.
We have a BOS knowledge portal where you can go, and there are case scenarios as well as MCQ questions are already there. So from there you can practice as well. We have both MCQ independent MCQs as well as case scenario based MCQs.
Okay. Thank you, sir.
Okay. Still, if you could not get, please send me an email. Okay, I will connect you to the concerned person to help you.
Thank you, sir.
Okay, beta.
Oja is asking, please explain profitability index. Jini Oja, profitability index is essentially present value of your inflows divided by present value of outflows. So it gives you in present value terms for every 1 rupee of investment, what's the return that you're getting in present value terms itself. Okay, so I think this is a concept that we had covered in CA Inter.
Student, as I told you in the last before the this class topic was we are starting that basically intermediate financial management topic is the foundation of this topic, because here it is the advanced version. Okay, of course, I think Jagbandhuji, PI is not as much used in this advanced capital
Correct.
investment business. Generally, it is a NPV is more used here, because ultimately, if you have referred your 3 methods in this, it is already said that because we should always give the preference NPV, because it leads to increase in the wealth of the shareholders. Okay, so that's why generally it is more used here. Okay, student. I think there are no more queries.
No more queries, yeah.
Okay, students. Thank you very much for your attending this session, and thank you, Jagbandhu sir, for enlightening the student on this topic. Now, student, continuing this series, in the next class, we shall start with the topic of security valuation. Of course, the topic is security analysis is there, but since it is we are in the flow of numerical questions, so we are planning that we have planned that we should start with the security valuation topic in the next class. So meanwhile, you are revise the question that has been covered in today's class, and for the remaining solutions, the solution or the questions that has not been covered in the class, the solutions are itself in the study material. Okay. In fact, if you otherwise, if will be possible, we will get them uploaded separately. Don't worry, it is not a big issue. Okay, if any it is, please keep in mind, if the solution of any question is not available in the study material and that has not been discussed in class, we will get it uploaded separately. So don't worry about the same aspect. And Jagbandhuji, just share my email ID as well as a contact number so the student can contact me in case they need any assistance. Thank you. Okay, student, this is the, you can send your queries at mobile BOS app, or you can contact us at through email at this email ID, or even you can contact me at this number 0120. This is STD code 3045956. Okay, so my request to you, please, whatever doubt you have, if even I always welcome all the students who says कि sir मुझे इस study material में ये कई confusion है, या sometime it may appear to you that there may be some ambiguity in the, please discuss with me. Don't hesitate. Please discuss with me. I am always repeating. Please discuss with me. Okay, students. Thank you for the patient listening, and see you in the next class. Thank you, sir. Thank you. Have a nice day. Yes, session is over.